Hey, this is Matt Janino, and in this video we're going to dive into options and just learning about what they are, how they are traded, and how you can make money from them. I've been getting a lot of questions about options lately, and I've been doing a lot of teaching about them, so I figured I'd make a video to make it easier for everybody. So options are the trickiest thing to learn, but once you do understand them, you can definitely make a lot of money off them, and with very little risk, like 3-to-1 ratios, 2-to-1 ratios, pretty regularly. So an option is a bet that the stock will go above a certain price or below a certain price. So right here I drew a price level at about 185 for Apple, because that's where it is now. And we have options expiring today in the market with 0 days, and we have options that are 2 years out. So we have lots of different ways we can buy an option. We can say Apple is going to go above this price or below this price. With an option, it's the bet that it's going to go above or below. So if it goes above, it's called a call. If it goes below 185, it's called a put. So the only way you can make money is if it goes below, if you're buying a put, or if it goes above, if you're buying a call. You lose all your money if it goes against you and you expire within that time frame you bought it for. And I'll tell you what that means in a second. So basically, it's a one-directional bet, and you have to be right in that direction. So if you're a momentum trader, it's really profitable because you can leverage your money and pretty much grab a short swing with very small amount, and you can make a lot. So if I go to the trade screen, this is where you can see your options, and options are all listed here. You can open them up and see what strikes you can buy. So my options are a 0-day expiration. They're going to expire today, 7 days till expiration, 14, 21, 28, all the way down to 700 days. So the idea behind these would be, if you want to bet Apple's going to go higher than 185, but you don't want to be watching the markets every day, you don't want to be scared if it drops under, you would buy the longest option. Basically, this means that you have more time for Apple to go above $185, so, or go below $185. And these are popular because you can be wrong in the short term and be right in the long term. But if you are riskier, you can buy the options expiring today. And if you think Apple's going to go above 185 today, you can buy these, profit from them quick today, and sell them. Basically, once they expire, you have the opportunity to buy that stock at the option strike price you bought. So if I buy calls at 172, when I expire today, I have the option of buying those calls or buying those stocks at 172. So this almost never happens. Almost nobody does this. So I don't really want to go into this fully. I want to go into trading an option like if you have no intention to buy the stock. So if you thought it was going to go up today, you'd buy the 0-day expiring today options. And the reason you would do that instead of buying the super long 700-day options is they're very cheap. So if I think Apple's going above 185 and I think it's going to be quick, these cost 1.14, and you multiply that by 100, so they cost $114 for a 185. So you look at this, this is called the strike price. 185 call expiring today is $114. If I go out to 700 days later, it cost me $29, so about $2,900 for the 185 strike price. So why do you think there's a price difference in that? Because obviously if you think it's going to go up, you have to pay some type of premium, but what premium is being put inside this option? So I'll show you that in this page right here. So the 185 strike, if I go out till, let's say, June 29th next year, you can go out even further. Or sorry, this year. Let's go out next year. So I calculate it, and those cost $1,198, a little bit less than those 700-day options. So what you get when you buy this option is you have to pay for the time value. So because it's longer out and you have more time to be right, you have to pay for that time. And that time is in the theta factor. So this factor of theta is the minus sign, means that's how much you're losing per day. So in a theta, you'd be losing about $3 a day for these Apple calls. So I don't really see that happening when I have an option. I don't see myself actually losing that amount, but it's priced in to say it's losing $3. The velocity of theta loss increases towards the ends of the options. So if you have an option that's expiring a year from now, it's going to lose less theta value than when it is expiring, let's say, next month. So if it's expiring in July this year, you're losing about $10 a day. So big difference. You have this huge factor increase when you get closer to your expiration date. And the vega is the volatility increase. So that's good for you because there's no minus signs for anything else. So volatility increase means if Apple gets very volatile and the volatility increases for Apple, then you're going to make $14 for every volatility point increase. And if Apple's been if it's been not so volatile for a while and you want to just profit from volatility, you can buy a call. And even if it goes down, you can make money because volatility will increase and your option value will increase. So all of these prices go into this option value number. And we got two other factors. We got the rho and the gamma. Oh, and the delta, so three others. Delta is the most important one, honestly. The delta is how many stocks you control at this moment. So with a $281 option, I control 50 stocks of Apple. So let's pull up a calculator, calculate how much money that is. So 185 times 50. So you control $9,000 with $300, about 300. So that's a 30x factor that you can control. I think that is insane, and it's amazing. It's really helpful if you want to make money. You can control so much with so little, and you're risking so little. Because if I can only lose 300, but I could double or triple this, it's a very no-brainer option to me. And the best part about options, in my opinion, is if the price does go up and you are correct, you start making more per dollar. So now I control 77 stocks. So if I control 77 stocks, every dollar increase of Apple increases my option value $77. So boom, I just made $77. And now I control 81 stocks. If it goes up another dollar, I have $770 now. Now I control 85 stocks. If it goes up another dollar, I control 88 stocks, and now I have an option value of 857. So that's how much money my option would be worth if it went into the money. So right now, it's called into the money if you have a 185 call. The further it goes above 185, the more into the money you are. And this is how you control more stocks as you go further and further into the money. So these guys here in the 125 strikes probably control maybe 100 stocks of Apple. And the other thing that happens is if you go below 185, you start controlling less stocks. So now you have 24 instead of 50. But the good part is, if you think about it, you're losing less money per dollar drop now. So you're losing money less quickly. If you go to 175, you're only controlling 7 stocks, and your option's worth $20 now. So for you to lose all your money, it'd have to be a pretty bad bet, in my opinion. But let's go to the options screen again. Oh, I forgot to go over the last two. So rho is the amount the option will change per dollar swing, and gamma is the amount the option will change if we get a dollar swing. So if we go to 176, gamma is telling us our option is going to go up $2, and it goes up a little bit more than that. So I don't really pay attention to these ones, honestly. I just really think the biggest ones are vega, theta, and delta, and most people understand that as well and pay attention to those. So the other thing that goes on is when you have a put, you are losing money per delta. If you go up, you're losing money per theta, and you're losing money per rho. So there's a lot of strategies you can do with options, and it's really something to look into. I hope I described them well and you understand them. Basically, it's a bet that the option or the stock will go to a certain price in a certain amount of time. And if you are very bullish on a stock, the way this is profitable is you go outside the money. So instead of the blue, we're going to go into the black, and that just means that we are above the price if we're in the calls, or we're below the price if we're in the puts. So let's say I think Apple's going to go to $200 in 42 days. So that's kind of cutting it short for a $15 move. But if I'm super bullish, then let's say these cost $180. And if it does move this quickly, this is what I like to do. Let's say it moves this quickly in 20 days. So I go to the 21-day options. So 20 days away would be about 21. So from 42 to 21, my options are worth, well, let's say I would be in the money. My options would be worth about $400. So if Apple makes a 15-point run from 185 to 200, I would have a $180 option that becomes about $390. So that would be doubling my money. So if you were bullish and you had some evidence that this could happen statistically or with a chart, then you could double your money in about 20 days. And you would only be risking $180. Or if you want to risk more, you can do that. But if you go outside the money, you have more potential to make more money. Because like I showed you earlier, you're controlling less stock, but the more it goes up, you're controlling more. So you want to buy outside the money if you're bullish. So hopefully this video helps. Let me know if you have any questions, and have a great day. Peace.